Hey everyone, Couch Investor here back with another video for you today. So in today's video, we have Dave Lee coming on the channel. In this part of the three-part series, we're going to talk about how Dave started to go into investing, the green pastures, the apps, Tesla. We're also going to talk about how he looks for his next 10x, 100x investment. And we're also going to talk about Stripe in this part. In the next couple of parts, we're going to talk about Square, Lemonade, the genomic revolution, and obviously maybe look inside his portfolio. So stay tuned for that. But as of now, enjoy the interview. So first up, we have, obviously the beginning. What kickstarted your investment passion or interest? Because I know you started building apps at first. Mm-hmm. So let's first start maybe with the apps. I know it started when Apple launched their iPhone. Then you went into something that you like to call the green pasture. So yep. I want to hear a bit more about that.
Yeah. So, most of my investing journey actually goes way before that. So, when I was maybe about 11 years old, I got introduced to stocks in one of my classes, and we had the stock competition where you had to go to the newspaper and pick kind of a selection of stocks and track it over a few months, and whoever wins whoever gains the most, wins the competition. Yeah. And that fascinated me, and I started to read the business section of the newspaper almost every day. In high school, I started to get fascinated with business. And actually, this is the first time I've actually, I think, shared this publicly, but one of my fascinations was I was listening to this business talk radio show. And people would call in with all these business problems and situations and a little bit investing. But when I was probably between the ages of 14 and 17, I listened to this probably 3 hours a day, just constantly, almost every night. I would listen to this business talk radio show, and I was just fascinated about business. I joined a club in my school called Future Business Leaders of America. Mm-hmm. And it's a competition where we go to different contests, and we would formulate a business right on the spot and compete. Like they would give us maybe an industry or something, and then we'd formulate a business plan and a model and present it. And I wanted to go into business for college, but everyone I talked to said, "Oh, it's better to major in something different in undergrad and later business." And so I got into. I majored in political economics at UC Berkeley. I started to, I spent 6 months abroad in Korea and learning about East Asia politics and economics and how these Asian countries were able to grow from dirt poor countries into these huge economies. And I started to understand the dynamics between government and economics and business and all these other factors. After college, this is like after grad school, I was back in the States. I went to grad school overseas. I came back to the States in 99. My dad had given me $5,000. Actually, it might have been $10,000 to invest. Now, my parents kind of very they come from very poor background. They were just like, dirt poor. I grew up in this very financially oppressive household. So I never got allowance or anything. Mm-hmm. So this is almost like the first time ever, my parents actually gave something, and they actually didn't, support me at all much before that or after. But I took that 10,000 and I started to put it in the stock market. And this was during the internet boom. Okay. And I saw potential. I'm like, I got really into the internet to understand the dynamics, and I'd grown up in Silicon Valley, so I had seen the progress, and I knew that in 1999, I had this realization. I'm like, I think Silicon Valley is going to be the center of the world in terms of the trends for the next 20, 30 years. And back in 99, that was kind of crazy because Silicon Valley was just this tiny place. Yeah. And I started to see what the internet is doing is going to be the biggest change in our lifetime. So I started to invest into Yahoo and all these other companies. And I saw my portfolio grow. And my philosophy back then was every doubling of my portfolio, I would take half off and give it to charitable purposes. So I saw my portfolio go from 10 to 20,000, took off 5,000, right? From 15, and then went up to 30,000. I took off another 5,000. Mm-hmm. And it went up to maybe 40,000 within a year. So 10 to 40,000 within a year. And then the .com crash happened and it just tanked. And I was just like, oh my gosh. And my portfolio went down to $10,000. And this was after, taking out 10, but I pulled all the investments and I said, forget it. This is too unstable. I don't know what I'm doing with the stock market. I shifted, that was kind of like a hobby. And my big actually passion at that time was helping the poor, helping the kind of the underprivileged, helping those stuck in mental illness and addiction and poverty. And so I started to dedicate my time full time to helping people both locally and also overseas. And so I formed a nonprofit and started to find out the biggest needs in different countries and locally started to do what I could do. And I was just focused head down on that. And I just didn't have much interest in business or investing per se. I was like, I need to there's so many needs, locally and around the world. And the thing is, after 3 or 4 years of doing this, I started to, I'm traveling to all these countries in the world and I'm starting to see immense poverty, but I see huge business activity from entrepreneurs and just people on the street and vibrant economies together with this crazy, poverty. But the vibrant economy is growing so fast. And I'm like starting to see investment opportunities. I'm like, oh my gosh, if I had capital, I could just, be investing in businesses. And this is an amazing opportunity. And all the while I'm doing this nonprofit, I'm struggling to find donations. I'm living a bare existence, right? With my own living expenses. And this just feels just doesn't make sense at all, And so I started to dive into the bookstore for 7 years during this period. I started to read business books and investing books. I probably read a few thousand of these business and investing books, and I started to get a sense of what everything was about. Like I started to get a sense, this is what I understand the essence of business and I understand the essence of investing. And in 2007, that's when I got married and I told my wife, hey, let's spend a year looking for a lifetime approach to business and investing, something we could really get behind. And that's when I started to, formulate kind of my own strategies and look around. And I wasn't happy with almost anything I saw. Everything I saw was so traditional. Right? I was like, okay, I did a deep dive into Jim Cramer and Mad Money. I'm like, read all of his books. I'm like, this guy's just, I don't know, just too traditional. I don't see it tapping into the essence of business and investing, because what I've seen, what I know is investing and business is exponential and growth, but none of the investing paradigms out there were exponential. They were all incremental, saying, 8% gains, 10% gains, if you're lucky, 15% gains. Yeah. Everything was just so incremental. I'm like, I don't think people are getting it. I think something is missing. And so I actually had to come up with my own philosophy. I call it green pastures investing, where I say, hey, let's put our resources into the greenest pastures, and just like sheep, they will reproduce. And if you are taking your sheep to the greenest pastures and everyone else is stuck near the city, near these barren pastures, because there's too crowded by the city, you're going to grow faster. You're going to have faster exponential growth. And so that led to my first big move, which is the App Store. And we started a software company making apps. And that provided capital it posed a problem. We started to have savings that was growing, and I didn't want to stick into an incremental kind of preservation investment, because I felt like there was too many needs in the world. We were too young. Like we didn't have to worry about retirement at this age. We had some other assets. So I'm like, we need to really go for it. Look at what's the potential behind investing. Mm-hmm. So I knew it was exponential. I knew I had to do something exponential. I couldn't find it. I spent 2 or 3 years looking. Finally came across Tesla in 2012 with Elon Musk, did a deep dive into Elon for 6 months, started to invest all of our business savings into Tesla over a period of about 6 months. And then it was like a waiting game. It was like just waiting for Tesla to, deliver for the company to prove it themselves. And so that's kind of the background, I think, of most of my investment journey.
All right. No, I think it's pretty incredible that you saw the App Store, the whole App Store ecosystem way before the masses actually saw it, which is also going obviously helped you invest in Tesla when you did in 2012, I think. So back then, and looking at it right now, why is it that nobody actually wanted to invest in Tesla back then? Like, what's the big reason? Everybody said Tesla, no way.
Yeah. So here's a concept I'll toss out is I don't think people are looking for exponential investing opportunities. I just think it's just, in a way, you find what you look for. So if you're looking for something, that's what you're gonna find over time. And it's so important what you define. What goal do you have? What are you searching for? What problem are you solving? For me, my problem was exponential investment and growth. When people typically get introduced to investing, people don't talk about this. They think exponential growth is risky, it's too risky. And they think it's just a lottery. You have to just guess whatever companies, right? Mm-hmm. And no one has a way to figure it out. And for me, it just didn't seem right because I'm like, everything I know about business and investing, the great companies, they stand out. It's like, sure, you could make mistakes, but to say that you can't pick a great company, it just didn't make any sense at all. And I think when going to Tesla and also, let's say, the App Store, if you are looking for green pastures, meaning if you are looking to exponentially grow your sheep, your resources, I think you would have caught the App Store if you were, watching the Apple story, because that's something you're looking for. But if you're not looking for exponential growth, then you look at the App Store and you're like, oh, okay, whatever. Just, you don't see it the way that perhaps what your brain is looking for, Yeah. Same thing with Tesla. If I wasn't looking for exponential growth, if I didn't, like, we had a growing savings from our business, and I was like so against mediocre returns. I was adamantly against it. And there was like, my wife was like, put it into some interest-bearing account. I'm like, no, we need to find exponential, something that just really can grow this doubling at a reasonable, in a short enough period of time. I'm not talking about doubling in just like 6 months, but hey, doubling every 2 or 3 years or something, just, better than doubling every 10 years or 15 years. And because I was looking for that, it helped me to parse through all of the mediocre and above average opportunities. Because when you're searching for something, an opportunity comes up and you get engaged and you think, oh, maybe this is it. But if you don't know what you're searching for, you have 100 things that tempt you and confuse you. But for me, I'm thinking, exponential, man. I need this, double, 10x in whatever, 5 or 10 years. So if it doesn't meet that criteria, I'm passing. So I'm passing by hundreds of opportunities because I'm searching for something. So when Elon Musk comes about with electric cars in a possibly $1 trillion industry, that it's obvious is going to electrification. The question is, this is exponential possibility. The only question is, do they have what it takes? Yeah. Does Elon Musk in his strategy, does Tesla in their product superiority, right? In the execution, do they have what it takes to be the big winner in this field? So it's a whole different paradigm of looking at things. And I think it's obvious to me, the traditional investing world, they have to miss out on Tesla in the early days because it goes against everything that traditional investing world stands for: preservation, mediocre gains, right? Just safety, all this stuff. They're not looking for exponential gains, right? And yeah, it basically comes down to you find what you search for, right?
Yeah, I think that's also why ARK Invest, Cathie Woods are outperforming all those people. They're actually looking for those exponential growth. And back then, I think people were maybe comfortable with those 8% each and every year. So when you're comfortable, you're not really looking, how can I grow even more? How can I gain even more wealth over time?
Yeah, I think also what's interesting is it's the democratization of information and investing, where before, let's say 10 years ago, the investing world is pretty much predominantly, dictated by big institutions, and their business model is management. They're taking management, the whole mutual fund world and everything, even ETFs, it's like management fees, right? And so if your business model is management fees, you want people to give you money to you. You have to give them a reason. You say, hey, we have more information, we have more knowledge, we could protect your money better, etc. But what's happened in the past 10 years is there's been a massive dissemination and access to information in a way where people are thinking, wait a minute, is that the best we could do? 8% a year. And is the best we could do is a mutual fund with 50 different companies that I don't even know. Do I want to be invested in Bank of America and Shell and BP and GE, and like people are they're starting to see things and they go, wait a minute, why can't I be invested in these amazing companies that are changing the world right now, and I know they're going to grow. And so there's been a massive revolution just within even just the past several years.
Yeah.
And I think now you're starting to see stories of people who are owning that and who have lived that for the past 10 years and who are showing massive gains that can't compare with traditional markets. And it's starting to become, interesting. It's an interesting story. I think we're still in the early innings of this whole thing. But those who can pick out the truly the big winners, they're going to see massive, massive gains in their portfolio. And it's not even going to be you can't even compare, to the preservation-focused traditional investing model.
Yeah, no, for sure. I want to touch back on this 10x, 100x point, because that's something a lot of the viewers have asked is how do you go to work to find those next 100x or 10x or 2 times 10x, which is basically the same thing. That was, I think, question number one people wanted to know.
Yeah. So it comes down to, like, first off, I actually have been surprised by Tesla. I was hoping for a 10x for the first 10 years and another 10x for the next 10 years. So 100x for me has come kind of earlier than I expected. But I think there is actually some temptation to want to get, a doubling or 5x, 10x super quick. And I think the more you do that, like, I think there is a role for that. And you need, I think, to have higher risk tolerance, maybe a smaller basket of play money where you could trade and et cetera. For me, my bulk of my investments kind of approach is, I want to feel confident where I could track the company. I have a competitive edge over other investors or funds and the general public. So I want to have intimate knowledge of this company to the point where I feel like just people don't get what they're doing, right? And so what I'm doing is I'm looking for the best of the best. And a lot of it is, for example, in the fintech space, there's a lot of interesting companies coming out. And I actually, do a lot more research than I share in my videos, because a lot of what I consider myself more first as an investor. So a lot of times videos are time consuming to package everything. Yeah. So for example, I'll go through, let's say, a SoFi, or I'll go through, different, new companies out there. I'm doing a deep dive into the DeFi, decentralized finance space right now, but I'm going through this stuff, and sometimes it seems interesting. I'm like, hey, kind of interesting company. Like, for example, SoFi, I'm like, yeah, I kind of see their model. And I've taken kind of a small exploratory position on this because I want to look deeper into it. But one of the things that usually kind of stops me from progressing is I compare it to who I think might be the best of the best in that field. And Stripe. So, yeah, when I compare it to Stripe, I just lose. I don't want to say interest, but it's just, sometimes when you find a company that's so stinking, just like good with execution and their product and everything. It makes like, it's like comparing Tesla to, I want to say GM, but maybe comparing Tesla to BMW. It's like without Tesla, a BMW is a great car. You're like, hey, BMW driving around fine, Mercedes, Audi, right? That's fine. But once you have that Tesla, then it's like, oh my gosh, like BMW sucks, right? So with like in fintech, it's like, yeah, who is the best of the best? So that's my big question. Every time I analyze a company, I'm like, who is the best of the best in this category? And I need to find that out, and I need to compare all the companies to that best of the best. And that's kind of how I look at things. Sometimes the best of the best, though, their value too high to get that 10x within 5 or 10 years. Maybe you can in this kind of new environment where I don't know how people are really valuing things anymore. But yeah, so my hope is, for example, with Stripe, I'm trying to get in private equity, like in the pre-IPO phase, but it's extremely hard. It's probably the most difficult company to get into right now. And my strategy is I can get in under 100 billion. I think this is going to 1 trillion within 10 years. I think they are the dominant player, Stripe. And my problem is I don't think I'll be able to get in right now under 100 billion. So, I mean, yeah. Anyways, that's kind of some of the thought process, of how I see it. Yeah. Looking for 10Xs.
Now, obviously, I wanted to talk about Stripe. I think last time they got valuation was, I think, at $70 billion or so. So they're probably going to go public with a 100 or maybe even more, which probably sucks for retail investors. But like, if you want to talk a bit more about Stripe and what makes them like the number one over companies like SoFi, Square, like from what I understood, maybe a little bit, is that like Unity, for example, SoFi also offers all those APIs. If you want to create this, if you want to create that, they already offer that, which makes it so much easier for people to start a business, start a subscription model, etc. Maybe obviously you can explain a bit more about why Stripe is probably the number one in that space.
Yeah, there's a lot of factors going on with Stripe. And part of it is, I mean, I'll share as some angles I think that people haven't maybe heard of, because some other angles they can find out more easily. So I'll share some things I think is difficult to find that gives some value. Stripe is fascinating because they're one of the most loved companies in the developer community for the past decade. And developers are super smart. They are the guys and the gals who are coding stuff. They are on the bleeding edge of technology. And running a software company for over a decade myself, you start to see the differences. If there is a company that provides a far superior product, they get the outsized share of the market. And then you start to see how they operate, how they manage their products, how they improve them, what areas they go into. So I'm looking at it from a software kind of developer perspective. What I'm seeing is Stripe nailed it almost 10 years ago with their first APIs. Developers just fell in love with Stripe. And then for the last 10 years, they've actually kept that love of the product from their developers by expanding their current set of products, but expanding into new different product areas. And when I look at it from a software developer perspective, there aren't a ton of companies that have been able to do what Stripe has done in terms of how loved they are from the developer perspective. That's one angle. And for a lot of people, that's going to be hard to grasp because they're just not looking at it from a software developer perspective. Yeah. But if they know a software developer, they should probably ask that person, hey, what do you think of Stripe? How are they different than any other company out there? And Stripe is just leaps and bounds. They're just, everything they just do it far better. It's just far simpler. They make complex things super simple for the developer to do. Anything financial. The second thing is Stripe probably has the most ambitious goals in fintech out there. I know Square has ambitious goals. SoFi, lots of these companies want to be the vertically integrated, full financial, right, services provider for customers and businesses. But Stripe goes beyond that. They're just like, they're crazy. These guys are super ambitious. They want to help people start their own businesses. So they have a kind of this automated, corporation service that they provide. They want customers to make it easier to run their entire businesses. So they have a new platform they're developing to kind of see operations and to analyze analytics and to see where they could do better decision making. They actually have a banking API, and that's one of the reasons with SoFi they have Galileo, this banking API, which they're touting. But I mean, that's great until you see what Stripe is doing, and their API. They're making the APIs for the biggest banks in the world. They want to be the financial infrastructure for the entire kind of financial world, that even the biggest banks in the world use their APIs. That's Stripe's ambition, and they're moving so fast. And another angle is Stripe has probably the smartest engineers out there in terms of financial space. And the engineers are happy at Stripe. I mean, this is really hard to do. A lot of times when you're with engineers, they're in a company, but they don't really like it because it's really difficult to fully utilize 1,000 or thousands of engineers who are really, really smart. You get them into these mediocre, mundane tasks, and management doesn't communicate well, and it's just like people are like, whatever, right? Like for example, I had a friend who was working at Twitter, and he was like complaining about Twitter all day long, how poorly run it is, all this stuff as an engineer. But I mean, that's typical. Like engineers, for them to be ecstatic about a company and how it's run internally, that's really rare. But that's the norm at Stripe. Is these engineers go into Stripe, they're like, whoa, man, I'm super impressed by how they execute, how they communicate, the ambitious goals, how I'm involved with challenging products. That type of company, it doesn't come along very often. Yeah. And then you have certain people who are insiders. Like, for example, there's this guy, Paul Graham from Y Combinator. It's a Silicon Valley incubator, and they incubated Airbnb and Dropbox and hundreds of other companies. And Paul Graham is one of the biggest fans of Stripe. He thinks it's going to be huge. And he doesn't publicly come out in favor or in support of many companies. There's probably a good 4 or 5 that he's really staked his, claim to or his reputation to over the years. And one was Facebook, when it had IPO'd and it had tanked a bit. Everyone was hating on Facebook, and Paul Graham stood up and he says, guys, you guys don't understand Facebook. They can flip on the revenue switch, whenever they want to. Yeah. This is going to be a massive machine. And that was one time. Another time was Tesla. 2012, he's like, Tesla is like, you can't compare this car. They've redefined everything. And he really likes Airbnb, and he really likes Stripe. Right. There's a few others, but he's seen, hundreds and hundreds of companies, but there are certain companies that stick out when you're an incubator like that. But I can go on for a long time on these like intangibles, right? And if you see the interviews for these founders, you see how differently they think. They are not long-term. They are ultra long-term. Yeah. Like beyond anything normal. They are just extreme. But yeah, and the difficult part of Stripe is they don't have their financials public because they're a private company. So it's hard to know exactly what their growth is, but you could gauge kind of what's happening because you can see their competitors and you see what type of products they're offering and stuff like that. But if Stripe goes public this year, I just hope it stays under 200 billion. I mean, this company is crazy. Yeah.
Because I've read also some rumors that they might be a SPAC merging with them and take them on the public market. Don't remember which one it was, which could be helpful if we want to enter earlier. But on the other side, what if they don't merge with that SPAC? You're left with investing in just a blank check company. But I really hope Stripe goes public under $200 billion. So at least you can 5-6x that investment in the next couple of years, 10 years, maybe.
Yeah. I mean, nothing's guaranteed, but it's all about odds. People have been rumoring the SPAC with Bill Ackman's Pershing Square, right? SPAC, I think it's PSTH, which is ridiculous. And here's the thing, I mean, okay, when I come up, like, there's some things that are just ridiculous, and they still get traction because people believe in this stuff. Like the Stripe CEO even came on a thread saying that they're not going, public with this SPAC. He actually came on this thread saying this is ridiculous. Yes, people still believe in it, right?
Yeah.
And it's common sense. Stripe is the number one private company in the entire world. It's Stripe and
And
SpaceX. Those are the
SpaceX, yeah.
two major ones. Stripe is even more difficult to get into than SpaceX. I mean, people don't understand what the demand is for Stripe right now. And Stripe and their long thinking founders, they're not trying to rush to the market. There's no reason for them to do a SPAC, right? They're not trying to, IPO and cash out. There's absolutely no reason. There's some reason where after they can get kind of, decent, let's say, close to profitability, and they can see, some future growth where they could open up to public markets because, they can give liquidity to their employees. There might not be that much downside. They could see, some more upside long term. And when they do that, they're going IPO directly. They're doing it. They're not going to involve a SPAC, which involves trying to partner. They don't need to partner with a company to help them go IPO. This is going to be one of the biggest IPOs ever in the history of the financial markets, and they don't. It's just completely, yeah. It doesn't make any sense to do a SPAC, and I've said this before, and we'll see. But yeah, this is something that is fairly obvious to me. Yeah, Stripe goes IPO on their own terms, and yeah, they know that's what they're doing.
Yeah, no, I think people are way into this SPAC game right now, with Shamat SPACing every company he sees. I believe there is like a little SPAC bubble right now, because like every day I see another rumor, this company is going to merge with this SPAC. I'm like, whoa. I mean, since when are people like looking for SPACs? Like if a company wants to IPO, they'll probably IPO on their own, unless maybe there's something shady going on and they really want to go into the public market. Don't want to point any fingers to Nicola, but that's a prime example.
Yeah. I mean, I think there's two sides to this. One side is, I think what Uber and some other companies showed is, hey, you can not IPO for a long time, delay your IPO and just use private funding. And it could be okay. And so I think a lot of startups kind of had that mentality of, hey, we're not going to IPO in a super long time because profitability is still far out. So we're going to use the private markets. And then with the rising markets and the valuations people are getting in the public markets, it's starting to change some of these startups' mentality, where they're thinking, wait a minute, if we go IPO, we can actually maybe raise funds at a higher valuation. People get liquidity. Maybe there's more positives to that. And so there's been a massive shift where these private companies who were thinking of IPOing much later, I say in 5 years or something, when their financials get better, they're tempted to IPO now. But I think going through a SPAC actually makes sense for them because it shortens the process, it shortens the paperwork. The SPAC, partner has a lot of expertise. It makes a smoother transition. They're not so much in this spotlight of all of their financials. And if I was a startup like that, hey, SPAC it, like it could be a great opportunity to do so and secure some funding, a higher valuation. So in that sense, it makes sense. I think there are going to be some SPACs, some companies that do very well that actually, they were destined to IPO 5 years, but they IPO'd early. And maybe in a market correction, we can pick up some of these, great companies kind of at depressed prices, and we can see a 5 or 10x, reasonable amount of time. There are going to be companies like, especially in the EV space, who are just pumped up right now, like Lordstown and a bunch of others, that I don't know, they don't seem viable as a business in the future. And so it's interesting. I think it's an opportunity on the short side at the right time. I don't know what the exact right time is, but it's something I've been thinking about, just in a market correction, or at a certain point, perhaps this bubble of this EV bubble where they think all these companies are going to do well, right? That just isn't the reality. At a certain point, people are going to realize that it's not easy to make an EV company. And and there will be, I think, some type of sell-off.
Yeah, for sure. I think it's healthy for the market. I think right now a lot of people think they can get rich pretty quick, especially now with the whole GameStop saga going on. But it started already last year when everything went up after the crash in March. The EV stocks went up 5, 10x, 20x even. Pretty crazy. So I think having a little correction or maybe a bigger one is probably good for the market and will probably be good for investors for the longer term that will pick up some stocks that are cheaper after a crash than before.
Yeah, definitely. I mean, market corrections are part of the cycle. It's part of the market. The market's constantly adjusting. I mean, that's the power of the market, where it will, it's this. The market is larger than any single player in the market, because we're talking about trillions and trillions of dollars just exchanging just super fast across thousands and thousands of companies and different instruments. And in that sense, when you look at the role of a market correction, it's the market is constantly adjusting, and sometimes it adjusts a little bit, sometimes it over adjusts, right? And there's different ways, and it's so awesome and grand to think about how much even market or investor psychology and sentiment and media, all of this plays a part with the market dynamics too. So in a lot of ways, like the more I think people grasp all of the factors of how the market moves, they could take a step back to try to understand the psychology of the markets a little bit better. So when there is a huge correction, the big question is this just a correction, or is this the beginning of the end?
Yeah.
Is this like going down all the way? And so at that time, you can make that, assessment. And that's where I think huge fortunes are made, where you can make the correct assessment. I mean, and opportunities are lost also with incorrect assessments, and nothing's guaranteed either, right? I mean, could be making mistakes as well. So it's a part of all of the fascinating. It's part of the fascinating, game of investing, or the picture of investing.
Yeah, no. At the end of the day, it is a big game. Those who are playing the game for a longer term tend to outwin the people that play the game for a short term.
Yeah,